What we're talking about this morning is your InCommercial motor fuels offering. And so it's an offering that I find interesting simply because of the tax ramifications and that sort of thing. And as a result, I brought Jim Shaw, a good friend of mine, who is probably principally responsible for this, to explain motor fuels. So do you want to just go ahead and start?
Sure. Would you like me to share my screen so I have the presentation?
Yeah, let me allow you to share your screen. Okay, there you go.
Great. Okay, and Bob, thank you so very much. It is my pleasure to be your friend, and thank you for inviting me to participate in this webinar today. Before I start, I'm going to read a brief disclosure. The content provided is for educational purposes. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Securities are offered through JCC Capital Markets, a registered broker-dealer. Securities offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum. As Bob said, my name is Jim Shaw. I'm the president of InCommercial Property Group, and I'm very, very pleased to be here today and thank Bob very much for setting this up. As Bob mentioned, today we're going to be discussing the InCommercial Motor Fuel Fund 2 Limited Partnership offering. As I mentioned in the disclosure, there are a number of risk factors associated with this offering. All investing contains risk, and every investor and their representatives should very carefully examine the risk factors and benefits before determining whether this offering or any offering is suitable and appropriate for an investor. So the Motor Fuel Fund 2 Limited Partnership offering is a Regulation D offering sold pursuant to Rule 506C, which allows for general solicitation and subject to the limitations of a broker-dealer for advertising as well. We are acquiring what are known as retail motor fuel outlets, and we're acquiring these through sale-leaseback transactions, which I'll discuss in greater detail. We're seeking to raise $100 million from accredited investors and a similar amount from institutional and quasi-institutional investors. Our investment strategy is for income growth and capital preservation. The minimum investment is $50,000, and we're targeting a 4 to 6 year hold, so a relatively short hold period for the offering. Our investment objectives are to acquire motor fuel outlets and related properties via private sale leaseback transactions with retail fuel operators. We intend to generate demonstrable value by facilitating the financing of business and property acquisitions through long-term triple net leases. We intend to generate cash flow and capital appreciation for the investors over a relatively short investment period. We intend to maximize the after-tax benefit by focusing on qualifying assets for which 80% bonus depreciation can be applied in the year of acquisition, and we will seek a tax-efficient exit. So when we talk about motor fuel outlets, what we're talking about are gas station and convenience store combinations and also truck stops. And in order to qualify under the tax code as a retail motor fuel outlet, at least 50% of the gross revenues from the property have to come from the sale of motor fuel, which would be gasoline and diesel. And under the tax code, the Internal Revenue Code of 1986 as amended, any property where 50% or more of the gross revenues come from the sale of motor fuel qualifies as a retail motor fuel outlet and is then statutorily subject to a 15-year depreciation schedule, which by itself is very good because normal commercial properties are depreciated over a 39-year period, and multifamily properties are depreciated over a 27.5-year period. So with statutory 15-year depreciation. It's more than twice as quick as other commercial properties and almost twice as quick as multifamily properties. Under the Tax Cut and Jobs Act of 2017, any property that qualifies for 20-year or shorter depreciation qualifies for bonus depreciation. And in 2023, that bonus depreciation equals 80% of the depreciable components of the property. And I'll discuss that in greater detail. So while the offering is very tax efficient and can provide some very substantial tax savings, it's really an economically driven fund. We are really seeking economics with this fund. That comes first. After the economics comes the tax efficiency of the fund. The fund offers a 9% preferred return, which is cumulative but not compounded. After the investors receive 100% of their accrued but unpaid preferred return and 100% of their invested capital back, then we, as the general partner, start sharing in profits. We will receive a catch-up equal to 30% of the return that the investors received. And after that, every additional dollar is split 70 cents to the investors and 30 cents to us as the general partner. We're anticipating that we will be exiting the portfolio, exiting the fund, somewhere in 2025 or 2026. Although the fund does have the ability to carry out for 6 years, we've built in that extra time to really be kind of a runway in case we need some additional time if the economy is just not in a condition where it's suitable or appropriate to sell the properties at that point in time. But again, it's a really economically driven fund. We don't anticipate having any cash distribution in 2023. This is the year when we're raising the capital and acquiring the properties. We do anticipate in 2024, when we will be seasoning the properties, that we will start making cash distributions, probably in the second quarter. Right now, we're anticipating the distribution for 2024 will be 6%, and any additional amount above that for the preferred return defers and accrues. And again, the investors have to receive 100% of their accrued but unpaid preferred return and 100% of their invested capital back before we as the general partners start participating in profits. So we're often asked, why convenience stores and why gas stations? So convenience stores have gone through a real evolution over the last couple of decades. They're no longer just kind of an adjunct to the sale of motor fuel. As they've evolved, convenience stores have really become sort of a retailer of necessity for many people. As you've probably noticed, if you've gone to see a modern convenience store associated with a gas station, they're much lighter and brighter, the aisles are wider, and they offer substantially greater quantity of merchandise and food service with a much broader selection. So what we're finding in the United States is that convenience store sales and profits are continuing to rise. But at the same time, strong operators have limited access to growth capital, and therefore the capital that we're able to provide through the fund can assist them in their growth. At the same time, there's a silver tsunami of baby boomers that are retiring and a consolidation going on in the industry as a generational shift occurs. So in the United States, the vast majority of gas station convenience stores are still owned by individual operator owners. These typically are ma and pa operators that frequently own only one location, but sometimes own 2 or 3 locations. And as with the rest of the baby boomer population, in many cases, these owner operators are nearing retirement age. They want to be able to fund their retirement, and they want to monetize their investment in the gas station convenience store property. But they don't really have any credit to speak of, and they're not willing to lease back the operations because they want to sell and enjoy their retirement years. And that creates the opportunity for us to enter into sale leasebacks, which I'll describe further. So when we look at convenience store profits, as I mentioned, in order to qualify under the tax code as a retail motor fuel outlet, at least 50% of the revenues must come from the sale of motor fuel, which would be gasoline and diesel. But as it turns out, the vast majority of the profits actually come from the in-store sales. So as you can see on the lower left-hand side of this slide, fuel represents about 16% of the gross profits, merchandise represents about 29% of the gross profits, and food service represents about 53% of the gross profits. The profitability of the convenience store gas stations really occurs inside the stores, but the sale of motor fuel allows them to qualify for that short 15-year depreciation and bonus depreciation. As you can see on the lower right-hand side, convenience store inside sales continue to grow at a relatively steady and predictable rate. In 2020, total convenience store sales in the United States were just a little bit over $263 billion. So the other question we get asked is, with the advent and the rise in popularity of electric vehicles, aren't internal combustion engine vehicles that are powered by motor fuel, gasoline, or diesel, aren't they really quickly becoming a thing of the past? And despite the the news that we hear of the rise in popularity, sales, and operation of electric vehicles, they still are a very small fraction of the total vehicle usage within the United States, especially when you take into consideration not just cars, but light trucks as well. An example of this is that in 2020, in the United States, about 123 billion gallons of gasoline, of motor fuel, were sold, which equates to about 337 million gallons per day. And in 2021, that number had increased to about 134.8 billion gallons per annum in the United States, which again equates to about 369 million gallons a day. So as you can see from this slide, even as the sale and operation of electric vehicles continues to rise, so does the sale of motor fuels within the United States. And we anticipate that this is going to continue for some time. The Energy Information Administration, which is a part of the Department of Energy, their job is to forecast and project what kinds of vehicles will be on the roads in the future, both domestically and internationally, and what kind of fuel or how will they be powered. So they do these projections and they update these projections regularly. Their current projection is that peak use of internal combustion engines will occur in 2038. And as you can see from the dotted line on this slide, we anticipate exiting the portfolio well before that. Again, we're anticipating going full cycle, exiting the portfolio in 2026, perhaps 2027, depending on economic conditions, but well over a decade before that peak use occurs. But also what's very important is that the Energy Information Administration projects out to 2050, and they look globally to see what kind of vehicles they think will be on the roads. And they're estimating that the global vehicle stock in 2050 will be approximately 2.21 billion vehicles, of which about 672 million will be electric. So you can see that even all the way out to 2050, the vast majority of the vehicles on the road are anticipated to be internal combustion engine vehicles, which are fueled by gasoline or diesel. So despite the rise in popularity of electric vehicles, internal combustion engine vehicles aren't going away anytime soon. And again, out to 2050, at the very least, are still anticipated to be the vast majority of vehicles on the road, both domestically and internationally. So again, that allows us to believe that the usage and the sustainability of the profitability of gas station and convenience store combinations will continue to be strong long into the future. When we're building this portfolio in the Motor Fuel Fund 2 limited partnership, we want to seek diversification. We want to seek diversification of the flag or brand, and we want to seek geographic diversification. So on this slide, you can see these are the properties that we currently have in our pipeline to acquire. And as you can see, it really represents most of the major brands. Now, one of the things that's important to understand is that when you go to a gas station and you see Sunoco or Shell or Exxon or Gulf or Chevron, that is not the owner of the gas station convenience store. That is the brand of fuel that has been sold there. It's kind of like if you go to a Hilton hotel or a Marriott hotel, very, very rarely do they own the hotel. They are the flag, the brand that is at the hotel. And the same with these brands of fuel. That's the brand of gasoline and or diesel that is sold at those gas stations, but they don't own the gas stations. Again, in the United States, the vast majority are currently owned by individual owner operators, and many of those are seeking or nearing retirement age, wanting to monetize their investment, no longer be operating the properties, and that's what gives us our great opportunity. We also seek geographic diversification. So as you can see from this slide, we're really focusing our acquisitions on the Midwest and the Central South. And we're doing that for a number of reasons. So first of all, electric vehicle usage is far higher, far more predominant on the West Coast and the East Coast than it is in the middle of America. And that's not surprising because the West Coast and the East Coast tend to be more urbanized areas where drivers drive shorter distances per year, and therefore the range anxiety that might otherwise occur by having to drive longer distance and worrying about charging stations isn't really nearly as extreme on either coast as it is in the Midwest. In the Midwest, which tends to be more rural in nature, drivers on average drive significantly more miles per year than they do on either coast. The distances tend to be further apart. And so that range anxiety really becomes a real thing. Also, because of the distances, the increased distance that the average driver in those areas drives every year, the necessity-based nature of convenience stores really becomes a factor. And that is tied with the increase in the types of merchandise and of food services that are sold within the modern convenience store. So in many cases, what we're finding is that consumers, drivers, not only are going to the gas station to fill up, but in many cases, they're getting their breakfast, their lunch, and in some cases, their dinner at these locations. 2 of our team members just came back from the convenience store conference, the National Convenience Store Conference, and it was really astounding, the number of types of food services, food products, and merchandise that were on display as the need for increased both quantity and quality of the food services and merchandise offered by convenience stores continues to grow. We are allowed in the fund to invest anywhere in the United States. We're certainly not going to be acquiring properties in Alaska or Hawaii. So it's really the contiguous 48 states. But even there, we have an intention in the fund to invest in not more than 5 states that impose state income taxes. We want to make sure that we're providing as little complication to the tax reporting as possible. And that's why, again, we're limiting ourselves to not more than 5 states that impose state income taxes. And we'll discuss some of the kind of the characteristics of that in a few moments. When we acquire these properties, we go through a very extensive due diligence process. Over the last 20 years, InCommercial has developed a very comprehensive due diligence process where we take a thorough look at the operator, the property, and the market in order to establish their valuation and terms that can be executed in a marketable lease. For us, it really starts with the tenant. Each potential tenant goes through a rigorous due diligence process where their financials and operating history are reviewed and approved. So as I mentioned before, the vast majority of gas station convenience stores in the United States are still owned by individual owner operators, and they want to sell those properties, but they don't want to enter into a lease, and they don't really have any credit to speak of. They're just individuals. At the same time, there are a number of very large companies, in some cases having an investment grade rating and others not having an investment grade rating, and they are in the business of fuel distribution. They're the ones who bring the fuel to those individual gas stations. Those companies want to be able to lock in on a long-term basis their fuel distribution contracts. So those are the companies that become our tenant in our sale leaseback transactions. And again, I'll describe that in a little more detail. Then we turn to the property. Each property is run through a checklist of requirements that include things like a property condition report, title and survey examinations, and very importantly, because these are gas stations, a phase 1 environmental site assessment, and if necessary, a phase 2 environmental site assessment. We do not acquire any properties where there's any evidence of environmental contamination or where circumstances would lead us to believe that there is a heightened likelihood of environmental contamination in the future. That's something that's very important to our process because we're really entering into this as the owner of the real estate, not the operator of the property. And we want to make sure that whenever possible, these properties are clean environmentally. We then move to the market. We review the market very carefully. We want to make sure that these locations in which we are buying these properties are relatively strong and have growing demographics. We also want to make sure they're the kinds of markets and locations where you do have a larger than average annual amount of mileage driven by the consumers in that area, and that they are also likely to utilize the convenience store, not just as a place to get a Snickers bar and a Coke while they're fueling their car, but really to take advantage of the increased merchandise and food items that are available in those locations. We look at the demographics. We look at all the comparable sales and comparable leases so that we can underwrite likely exit cap rates when we do go full cycle with the properties. And then if all those boxes get checked, we then enter into a lease. We enter into a lease with these fuel distribution companies, which again, typically have substantial credit. Our leases are 20-year absolute net leases, which means that the tenant is responsible for all operations, all expenses, the operating expenses, the insurance, the property tax. They're responsible for everything but our own income tax. Those 20-year leases include 2% annual rent escalations, and they include the kind of protections and covenants that we think are necessary so that we and the fund and the investors can be protected. An example of that is that the tenants are responsible for primary environmental insurance. And then the operators all pay into state environmental funds. We at the fund level have tertiary environmental insurance. And then finally, we hold each of the properties in a special purpose entity, a separate special purpose entity, so that if we had to, we could abandon that individual property without impacting the fund as a whole. It's very important, given that this fund is an economically driven fund, that when we buy these properties, we enter into a lease rate and a purchase price that is appropriate for the property, not just now, but in the future. So we look very carefully at the existing operations of the property, and we gauge it based on a metric known as EBITDA, which is earnings before interest, tax, depreciation, and amortization. And then we add rent to that. So it really becomes EBITDAR. And what we want to make sure is that the EBITDAR is a multiple of the rent that's going to be paid. So we seek lease rates that are where the EBITDAR is between 2.5 to 3.0 of the rent that's being paid. We want to make sure the profitability is strong because we think that it's important that these locations be durable, sustainable, and predictable in the future. After we've established that EBITDAR rate, we then apply a capitalization rate to determine the purchase price. And as I mentioned, the vast majority of these prior to our acquisition were owned and operated by individuals. So they don't really have a huge marketability because it'd basically be selling a non-functioning gas station and convenience store. So we don't want to overpay. That's one of the reasons we sent our rent level where we do, but then we take that rent and apply a capitalization rate. If we were buying these just on the open market, after a fuel distributor had already acquired them and become the tenant, the cap rates today are between about 6% and about 6.5%. But because we're entering into the sale leaseback transaction with the fuel distributor, and we don't want to overpay for the properties, we're acquiring these at much higher cap rates. So typically the lowest cap rate we pay is 7.75%, and that goes all the way up to about 9.25%. And the average, therefore, is kind of about 8.25%. So if you look at market cap rates being between 6 and 6.5%, and us buying them on an average of 8.25%, you can see that we have a very substantial spread that's built in between the price we're paying and the market price if we were to sell those properties on. And that's how we create value. That is the value creation process for this fund. So in a sale leaseback, we believe that value is really made upfront at the point of acquisition. It's made by us setting a rent rate that allows the operator, the tenant, to still be very profitable. We believe that it involves buying these properties at a cap rate that is substantially greater than market, so that we have a spread and it can achieve profitability when we sell the properties. When we do the sale leaseback, it generates liquidity for the operating company, which is really kind of equivalent to high leverage financing for them. The fuel distributors who become our tenant, they don't want to own bricks and mortar. That's not their business. Their business is fuel distribution. They want all their capital to be in fuel distribution and the growth of that product. And we think that that's critical to the success of these sale leasebacks. When we enter into that sale leaseback, we create a perfected security instrument, which is the ownership of the property. And that reduces the risk to us as the landlord, which allows for better financing terms for the operators. It allows them to grow their business more effectively. The investor, the fund in this case, owns real property with all of its benefits, tax, capital appreciation, and cash flow. And because we want to make sure that these are profitable, not just today, but long-term, that they're durable, steady, and predictable, that operator credit and unit level economics are critical considerations, as I discussed on the prior slide. So a sale leaseback transaction is really kind of a symbiotic relationship between us as the landlord and the tenant or the retail fuel operator. The tenant, the retail fuel operator, is responsible for operating the business. They're the ones who sells the gasoline. They're the ones who sell the merchandise and food items within the store. We as the landlord are the one who provides them with the property, the real estate with which to have that operating business. So it's really a symbiotic relationship where we're providing the property, but we have nothing whatsoever to do with the operating business. Our lease is an absolute net lease where we get paid our fixed rent with our 2% annual escalations, and the operator, the tenant, is responsible for all expenses associated with the operation of that property. Again, that would include the operating expenses, the insurance, the property tax, the environmental insurance at their level, allowing the fund to only be responsible for our tertiary environmental insurance and making sure that we're monitoring the leases to make sure the tenants are fulfilling all of their obligations and requirements and that all of the covenants are remaining in place and operable. So as I mentioned, we try to buy these at a cap rate that's substantially greater than the market cap rate. And we do so by entering into that sale leaseback transaction with a fuel distributor who wants to have the distribution contract, but doesn't want to own the bricks and mortar. So an example of this is that between November of 2022 and February of 2023, we acquired 25 retail motor fuel outlets. And that was our kind of prototype test. That was in our Fund 1. which was really available only to our existing investors. We acquired those 25 properties for a total price of just shy of $38 million. And then we retained CBRE Valuation and Advisory Services to value those properties. And those appraisals took place in November of 2022. So for those properties we bought in October of 2022, those were post-acquisition appraisals. For the ones we bought in February of 2023, they were pre-acquisition appraisals. When CBRE finished with their appraisal process, they concluded that the value was a little bit more than $48,500,000, an increase of a little bit more than $10,600,000, or an increase of 27.95% above our purchase price. And again, because we had them appraised so soon after or just before our acquisition of the properties, that increase in value wasn't based on increased rent or compressed cap rates, reduced cap rates within the market. It was really because when we buy them at an average of an 8.25 cap rate, and the open market for those is between a 6 and a 6.5 cap rate, we have created that value at the time of acquisition. Additionally, a lender retained an appraisal company in June of 2023, and when they appraised the property, their concluded value was 45% greater than our purchase price for those 25 properties. Now, obviously, past performance is not indicative of future returns. We can't say that the properties in Motor Fuel Fund 2 will experience the same increase in value, but we do think it is indicative of the value that gets created through the sale leaseback transaction. So I've mentioned that while the fund is very economically driven, it is wrapped in a very tax-efficient structure. And as I mentioned, that retail motor fuel outlets are defined by the Internal Revenue Code of 1986 as properties where at least 50% of the gross revenues come from the sale of motor fuel, gasoline, and diesel. And then under the Tax Cuts and Jobs Act of 2017, any property that qualifies for 20-year or shorter depreciation qualifies for bonus depreciation. And since our properties qualify statutorily for 15-year depreciation, they automatically qualify for that 80% bonus depreciation. One of the things that we think is important to note is that we're not relying on any kind of creative usage or twisting of the tax code. We wanted to be just straight down the middle of the fairway on this offering. We are following exactly the Internal Revenue Code of 1986 as amended to determine that these are, in fact, retail motor fuel outlets and therefore qualify for 15-year depreciation. And we are utilizing the Tax Cuts and Jobs Act, again, straight down the middle, where any property that qualifies statutorily for 20-year or shorter depreciation, in this case, gets that bonus depreciation. And given that our properties qualify for 15-year depreciation, they automatically qualify for that bonus depreciation. So when you depreciate a property, you can't depreciate the land. The land is not depreciable, but all of the improvements are. We anticipate that most of the properties in this portfolio will have a land value equal to about 5% of the total purchase price. It ranges between 5 and 10%, but on average, we anticipate that the average land component will be equal to about 5% of the total purchase price. So we're able to depreciate 90% or 95% of the purchase price of a property. We are going to leverage the portfolio by putting on first mortgage financing of 65% loan to value. So the $100 million that we're raising from accredited investors will allow us to buy somewhere between $280 and $300 million of total property. And that creates what's known as leveraged bonus depreciation, because every dollar of equity then has basically $2 of debt associated with it, all of which adds to the value. So we're able to depreciate 80% of the value in 2023. And after we subtract the land value, that means that about 76% of the purchase price gets depreciated in 2023. That equates to a loss multiple that we've estimated to be somewhere between 2.17 to 1 to 2.25 to 1, meaning that if an investor invests $100,000 into the fund, we anticipate it will generate tax losses in 2023 of somewhere between $217,000 and $225,000. Excuse me. What's important here is that these are passive losses. So passive losses get used to offset passive gain and passive income. And while the tax losses are generated in 2023, to the extent they're not used in 2023, they just carry forward into the future indefinitely. So what kind of passive income and passive gain can these offset? Well, most notably, it's investment real estate. Most people who invest in real estate are treating it for tax purposes as a passive investment. And I'll discuss that a little bit more in greater detail. But if you own an investment property and you sell that investment property and it's appreciated, then you're going to have capital gain because of that appreciation. At the same time, if you own investment property, you are going to have depreciated that property for tax purposes. And that depreciation gets recaptured when you sell that property. So you have a combination of capital gain, which is the appreciation of the property, and depreciation recapture, which is the recapture of the depreciation that you've enjoyed while owning that property. Those are typically passive gains. And the passive losses that we generate in the retail motor fuel outlets directly offsets those passive capital gains and depreciation recapture. So rather than selling a property and having to pay tax, or rather than selling a property and entering into a 1031 exchange, an investor can offset that capital gain and depreciation recapture by investing in the InCommercial Motor Fuel Fund 2. But in addition to offsetting the gain from the sale of appreciated property, the tax losses also offset passive income. So for most investors, who again are typically holding their property passively for tax purposes, and that doesn't mean that they're not active in the operation. So you can be actively operating the property. You can be handling the leasing, and you can be handling the repairs and maintenance, or contracting those out to other companies, and you can be handling the management of the property. But typically, you're still going to be treated for tax purposes as a passive investor. So the income you generate is typically passive income. A really good example of this is that if you acquired Delaware Statutory Trust or DST interests in the past, the income that's being generated from those is passive income. And if you did a 1031 exchange into buying those DST interests, then you carried across your original adjusted cost basis. So most investors that are investing in things like DSTs, and many investors who own their property in a sole ownership fashion, they own it themselves, have little to no remaining adjusted cost basis. So they have very little depreciation that's typically available to them. And so they have very little of that depreciation to offset the income they're generating from the properties. But the tax losses that we generate in the InCommercial Motor Fuel Fund 2 limited partnership are able to offset that income. So if I have, for example, $500,000 of income from my various DST investments, and I don't have any, or I have little depreciation with which to offset that income, the passive losses that we generate can be used to directly offset that income, allowing an investor, if they've scheduled it correctly and planned it correctly, to pay no income tax whatsoever on that income. And again, the tax losses are generated in 2023, but they can be carried forward indefinitely. So you can use them to offset the gain and depreciation recapture from the sale of an appreciated investment property this year, 2024, 2025, 2026. You can do the same thing with the income from your investments in real estate. Offset the income in 2023, 2024, 2025, and subsequent years. So it really becomes a very, very powerful tax planning tool for investors who own appreciated real estate that they're thinking of selling either this year or in a subsequent year, or they own real estate that's throwing off income for which they otherwise don't have shelter. Now, we are not in the business of providing tax and accounting advice. We are not qualified to provide tax or accounting advice. So we always strongly recommend that you seek counsel from your advisor, such as Bob, and your CPA or tax advisor before making a determination as to whether this fund is suitable and appropriate for you. But an easy way to find out if your real estate investment activities are being treated as a passive activity is to look at Form 8582, which is a part of your tax return. If line 3 is a positive number, that means the investor has passive income that should be investigated further to determine whether the Motor Fuel Fund 2 offering will generate the kind of passive losses that can offset the passive income and or gain and or depreciation recapture that investor is experiencing. And again, I need to stress, we cannot provide tax advice as we are neither tax professionals, nor are we familiar with any individual investor's particular set of facts and circumstances. And every investor should have their own independent, competent tax representation. And you should certainly be very careful to work with your advisor, such as Bob, and your tax advisors to determine whether this both is a suitable and appropriate offering from a tax perspective and from the investment side of things. We strongly believe that the tax tail should not wag the investment dog. And that's why, again, it's so critical that you work with your advisor, such as Bob, to make sure that economically this is a suitable and appropriate investment for yourself. As I mentioned earlier, the minimum investment from an accredited investor is $50,000. We, as the general partner, invest 5% of the aggregate capital commitments. We think it's very important that we have skin in the game. And by investing 5% of the aggregate capital commitments, that often makes us the largest single investor in the offering. Doesn't provide us with any special treatment, but we think, again, it's important that we invest alongside the investors so that we have skin in the game and that we have the same concerns and desires as the investors do. As I mentioned, the preferred return to the investors is 9% annual cumulative non-compounding. And to the extent that that preferred is not paid in cash in any given year, the remaining balance is deferred and accrued and must be paid back to the investors in addition to 100% of their invested capital before we, as the general partners, start participating in profits. After the investor has received 100% of their accrued but unpaid preferred return and 100% of their invested capital back, then we do start to share in profits. We get a 30% catch up. So after you've received 100% of your preferred return and 100% of your invested capital back, then we get the next dollars until we've received 30% of the return that those investors have received. And from then on in, because now we're kind of even, from then on in, 70 cents of every dollar goes to the investors and 30% of the dollars goes to us as the general partner. While again, results are volatile and we cannot be assured as to what results will be achieved, our modeling indicates that we would expect the investors to be receiving an internal rate of return of between 15 and 18%. And we don't just rely on our own modeling, on our own numbers. In the securities world, or sponsors such as ourselves typically engage a third party to provide a securities level due diligence report. And that's something that, for example, Bob has access to. So we engaged a company called FactRight, which is one of the leading, if not the leading, provider of securities level due diligence to the industry. And they go through with a fine-tooth comb our history, our operations, and the offering itself, the properties we have in our pipeline, and our prior track record. They take our numbers, they recreate them based on their assumptions and their criteria, and come up with what they think are the returns that the fund will produce. In their estimation, we're going to be providing about a 15% internal rate of return net to the investors. And again, our range is between 15 and 18%. So no results are guaranteed, but we think that we have looked at this very carefully, as have third parties, in helping us to determine what is the proper structure for the fund. Now, there are fees that are associated with the fund, and investors should be aware of those. There are substantial fees that come to us, but in all cases, we have tried to make sure that those fees are both market-based, and in many cases, those fees will go to a third party other than ourselves. But it is important when you look at an investment like the InCommercial Motor Fuel Fund 2 Limited Partnership, that you do take into consideration the fees that are charged. An example of that is that we receive a upfront acquisition fee for the purchase of the properties. And that fee is 6% of the purchase price for an investment. But we were able to show FactRight that this is both for services rendered, and that it is actually substantially below market rates. We're not trying to make our profit on the fees. We are being paid for services rendered, and we are receiving fees that then go to a third party for services they render. But again, you should be aware of the fees and take a look at those and ask your advisor, ask Bob about those fees, so you can get an explanation as to how they are generated, who they go to, are they market-based, are they for services actually rendered, and are they appropriate? Because we're buying properties that require us to have substantial knowledge of how they operate, retail motor fuel outlets, gas station, and convenience stores are different than a number of other kind of single tenant real estate. So it's very important that we as a sponsor have substantial expertise and experience in not just single tenant net lease properties generally, but in retail motor fuel outlets specifically. So the senior management, the CEO, the COO, and myself as president, we each have professional backgrounds exceeding 20 years. I hate to say it, Bob and I have known each other for a long, long time, and my experience exceeds 43 years. So, we have a lot of experience and track record within our organization. This slide, the team that's shown in this slide, is only a subset of the team within InCommercial. This is the team that's directly responsible for the acquisition, the financing, the management, the operations, and the accounting of the properties that are in this fund. Behind the group on this slide is a substantial team of accountants, property managers, asset managers, acquisitions associates, and such, so that we have a substantial team that backs up this team, which is directly responsible for the acquisition, management, financing, accounting, and disposition of the properties within the portfolio. So that's pretty much the presentation that I have. I had seen that there was one question in the Q&A, but that seems to have gone away. So, Bob,
I've answered that.
Okay. Well, what questions do you have for me, Bob?
Well, it isn't so much a question, Jim. It's the reason that you're here in the first place. I like to look at opportunities that provide tax advantages for my clients. And the one tax advantage that I like about this is the ability to use this in lieu of a 1031 exchange. And at the same time, because of the bonus depreciation, and at the same time, pull money off the table, so to speak. And for example, I'm working on an exchange right now, a personal exchange, where it looks like about 55% of the sales proceeds before taxes can be redeployed in motor fuels, leaving about 45% of the sales proceeds before taxes as untaxed money that I can redeploy elsewhere without being caught up in the 1031 cycle. That's why I like this investment. So that's my comment. And frankly, I've answered probably half a dozen questions while you were speaking. I appreciate you taking your time to come and visit with us and share with us what you're working on.
Excellent. Thank you so very much, Bob. And as you know, we're available anytime for conversations with you and your clients to discuss their specific circumstances and see how this might be, or if it is suitable and appropriate for them.
Perfect. And